Good morning, guys. Today, I'm going to discuss to you Strategic Financial Management, Module 1, the role of accounting in finance. After the completion of the chapter, students will be able to discuss the role and responsibilities of a financial manager, show how the financial manager is a business partner within the organization, and identify the value maximization goal of the firm as the most important objective. What is finance? According to Corporate Finance Institute, finance is defined as the management of money and includes activities such as investing, borrowing, lending, budgeting, saving, and forecasting. According to Wikipedia, finance is a term for matters regarding the management, creation, and study of money and investment. Specifically, it deals with the questions of how and why an individual, company, or government acquires the money needed, called capital in the company context, and how they spend or invest that money. Finance in the organizational structure. Finance acts as one of the most important parts in decision making. Whether you need to start up your business, adding new equipment, having a new branch for your business, selling or buying your stock, hiring or laying off your employees, or just simply adding a new product on your business. But why is that when we start analyzing, we forget the word finance? Is it because we tend to realize that it's only a matter of money, no more, no less? Finance in the organization is important because it integrates the value creation of the business through assessing if we need to pursue it or not. Whether your business is small or not, still, managing your finance is top priority. If your business is small, don't mind if you earn less than what you have expected. What's important here is your capital. Doesn't came from any borrowed money. Entrepreneurs should consider debt-free on your first year of operation. Avoid losing cash flow when you start to operate your business. Receivables from the customer should be collected on time because for some reason, some of the customers are not in good faith to pay their due. Guidelines for a more stable financing abilities. Number 1, open a business you really want, because if you want it, you will be delighted to do your business every day. Number 2, try to have a startup debt-free business. And number 3, avoid so much receivables. You need to collect it on time. Number 4, if your business is service, a 15% to 20% markup is viable for your business. Number 5, if your business is a merchandising business, a 40% to 50% is needed. In case of spoilage, at least you will still have profit at the end. And number 6, before you start your business, ask your family for help. Anyway, helping is caring. Feasibility plan is needed before starting up your business. Here, you can assess how much cost will be needed before the actual operation of the business. Number 8, take a look with your community, the place where you live. Here you can answer your question on who will be your potential customer. Number 9, open a social media account. It's free. It will be used as part of your advertisement. These social media like FB, YouTube, Twitter, Instagram can engage you with your own potential customer once you start the business. Number 10, be smart. You need to be sensible if it is specific, measurable, attainable, realistic, and time-bound. If just in case you will miss one of them, then ask yourself again, do I need to pursue it or not? If your business is a big or a corporation per se, there are many things you need to consider. Here, you may not be able to establish your business opening with 100% equity. That's why leveraging your finance is one of the considerations. Years back, the consideration of handling finance is between the company and the stakeholders who also assume the company's documentation. The company should have accounting department eyeing on the receivables and payables of the company, the internal auditor doing the financial analysis of the company, the external auditor eyeing if the company sustained the ability to prepare the correct historical financial statements, the Bureau of Internal Revenue for the accuracy of tax payment, and the creditor or lender of the company assured that the company have enough cash flow and vice versa. In today's generation, the impact of finance and CFO has changed. They are now divided into three: the subordinates, the business partner, and the value drivers. Subordinates includes accounting department, eyeing on the accounts receivable and accounts payable, and the preparation of financial reporting. Business partner includes eyeing on the financial analysis, tax, treasury performance, decision support, and management support, while the value drivers include sensitivity and risk management, strategic management, and executive drivers. Guidelines for more stable financing abilities for the big companies. Number 1, a corporation is an entity, that's why it's better to share your equity with the stockholder. Your problem will be the problem of all in terms of capital, that's why it's better to have allies. Number 2, do not put all your money once opening up a company. Instead, borrow some part of it that can be used as your additional capital. I know you pay interest expense out of your loan, and remember, it's not your money, but yet you're earning out of it. Number 3, leverage financing must be analyzed. It's better to have a higher return on equity than having a return on sales. Number 4, a good standing of financial statement and a good result of financial ratio analysis will be the investor's guide for a possible approval of loan arrangement. Number 5, always check the percentage result of your non-current liabilities against your total assets. Once result vary from 50% or more, will have a possible result that the equity are not maximizing its ending equity fully. Number 6, always check your cash flow. Remember, your company needs money for the continuous operation of the business. Responsibilities of financial manager. A financial manager is usually have knowledge in terms of financial analysis. He is in charge with the following duties and responsibilities. Number 1, every month end, his duty is to collect, review, and interpret the financial statement. Number 2, he is the one who predicts future financial trends. And number 3, he is the one in charge to report to management and stakeholders and advise whatever future business decision that might impact to the company's business. According to Karen Young, Investopedia 2019, a financial structure refers to the mix of debt and equity that a company uses to finance its operation. So we are dealing with if we are going to a debt decision versus the equity decision. Financial debt decision. The board of directors and the stockholders of the company agrees that there's a need to borrow money for the purchase of asset of a new branch, or it can be an additional money needed to pay a long-term liabilities or to borrow money to be used as an additional capital. Whatever it is the one of the major decisions of the stockholders. Financial managers serve as the intermediaries between the business partner and investor to decide whether borrowing agreement is needed and if it will be approved by the investor. Financial equity decision. The board of directors and the stockholders open the company to sell some share of stocks to the public in order to raise an additional paid-in capital. This additional equity can be used to purchase asset, open a new branch, start a new business, or either to invest in another business. The major decision should be approved by all stockholders. So whether the decision made for financial debt or financial equity decision, it should be agreed by all. This is the end of Strategic Financial Management Module 1, the role of accounting in finance. Guys, please answer the post test. Bye-bye.